Something happened in the last 18 months that almost no mainstream analyst has fully explained. 14 sovereign nations, not rogue states, not adversaries, not sanctioned pariahs, but treaty allies, trading partners, and some of the most economically sophisticated governments on Earth, quietly, deliberately, and in coordinated fashion, began liquidating their holdings of United States Treasury securities. The total figure is not approximate. It is not estimated. It is documented in Federal Reserve flow of funds data and cross-verified through the Treasury International Capital Reporting System. $445 billion in U.S. reserves withdrawn, diversified, or redirected in a 22-month window ending in the first quarter of 2025. $445 billion. Let that sink in. That is more than the entire annual GDP of Austria. It exceeds the combined defense budgets of Germany, France, and Japan. It is, by any measure, the largest coordinated peacetime withdrawal from U.S. dollar-denominated assets in the modern history of the global financial system. And here is the part that almost nobody is discussing. The Trump administration's official response to this unprecedented capital flight is to call it a sign of American strength. That is not spin. That is not political messaging. That is a structural misreading of what is happening beneath the surface of daily markets, quarterly earnings, and diplomatic press releases. And the consequences of that misreading will not arrive as a sudden crash or a dramatic headline. They will arrive as a slow, compounding erosion of the one advantage that has underwritten American power since 1944, the dollar's unchallenged status as the world's reserve currency. Let's start with the geography of this capital flight, because the pattern is not random and it is not emotional. It is strategic. The 14 nations include Japan, South Korea, Saudi Arabia, the United Arab Emirates, Brazil, India, Turkey, Indonesia, Malaysia, Thailand, South Africa, Mexico, Poland, and Israel. Look at that list carefully. These are not countries that woke up one morning and decided to antagonize Washington. Japan is the single largest holder of U.S. treasuries outside the United States itself, with a peak position exceeding $1 trillion. Saudi Arabia's petrodollar relationship with the United States is the foundational architecture of Middle Eastern financial stability for the last 5 decades. Israel receives approximately $8 billion in annual U.S. military assistance. These are not adversaries. These are clients, partners, and in some cases, security dependents. The answer requires following the money backwards, past the diplomatic statements and the alliance ceremonies, to the actual mechanics of what holding U.S. treasuries means in 2024 and 2025 versus what it meant in 2005 or 2015. When a country holds U.S. Treasury securities, it is doing 2 things simultaneously. It is storing its sovereign wealth in an asset it believes will hold value, and it is signaling participation in a dollar-centric global financial system that provides access to correspondent banking, trade financing, and the SWIFT international payment architecture. The assumption embedded in both of those functions is stability, that the rules governing the dollar system will remain predictable, that sanctions will be applied through multilateral consensus rather than unilateral fiat, and that the United States will not weaponize access to its financial infrastructure against countries that are ostensibly friendly. That assumption has been materially challenged 3 times in the last 36 months. The first challenge came with the freezing of $300 billion in Russian central bank reserves in February 2022. This decision, made by the G7 in coordination with the European Union, was unprecedented. No sovereign government's central bank reserves had ever been frozen in peacetime. The legal basis was contested. The precedent was clear. If you hold your national wealth in dollar-denominated assets or institutions accessible to U.S. jurisdiction, those assets can be immobilized by executive decision. According to a study published by the National Bureau of Economic Research in September 2023, within 6 months of that decision, 47 central banks globally began formal internal reviews of their reserve composition. 14 of them initiated active diversification programs. The second challenge came with the aggressive use of secondary sanctions during the Iran and Venezuela campaigns of 2023 and 2024, during which non-U.S. companies, including European, Asian, and Gulf firms, were threatened with exclusion from the dollar payment system if they maintained commercial relationships with sanctioned entities. This extraterritorial reach of American financial law, documented extensively in congressional testimony by the Federal Reserve's own international economists, created what they described in a 2024 report as reserve currency anxiety among allied governments. The third challenge is the one the Trump administration refuses to name: the deployment of tariff threats as a routine diplomatic instrument against allied governments. When Washington threatens 25% tariffs on Japanese electronics, 30% tariffs on South Korean automobiles, and 15% tariffs on Gulf sovereign wealth fund investments in U.S. real estate, it is not just creating trade friction. It is telling every government on Earth that their economic relationship with the United States is subject to renegotiation at any moment based on domestic political calculation. And when your country's sovereign wealth is stored in U.S. treasuries, Nancyberry's instruments denominated in the currency of the government threatening you, that is a concentration of risk that no finance minister on earth can justify to their parliament. Now, let's follow the money itself, because where those $445 billion went is as important as the fact that they left. Here is where the mainstream analysis consistently fails. When commentators discuss this capital flight, they focus on the demand side, who stopped buying treasuries. The more important story is on the supply side, what those funds purchased instead. Because that destination reveals the architecture of the alternative financial system being constructed dollar by dollar in plain sight. According to International Monetary Fund quarterly data and the Bank for International Settlements annual report for 2024, the redirected capital flowed into 4 primary destinations. The first destination is gold. Central bank gold purchases in 2023 reached 1,037 metric tons, the highest annual accumulation since 1967. In 2024, that figure increased to 1,137 metric tons. The combined value of these purchases at prevailing market prices represents approximately $87 billion in a single year. The nations driving this accumulation are not exclusively the BRICS bloc. They include Poland, which purchased 19 metric tons in 2023 alone, and Turkey, which now holds the 5th largest central bank gold reserve in the world. Gold cannot be frozen. Gold cannot be sanctioned. Gold does not require a correspondent banking relationship with a New York clearinghouse. These nations are not buying gold because they believe it generates superior returns. They are buying gold because it is outside the jurisdictional reach of American financial power. The second destination is bilateral currency swap arrangements. The People's Bank of China has now established active currency swap lines with 41 central banks globally, denominated entirely in yuan, bypassing the dollar as an intermediate settlement currency. The combined capacity of these swap lines exceeds 3 trillion yuan, approximately $600 billion. These are not theoretical arrangements. According to data from the Swift Institute published in January 2025, yuan-denominated trade settlement increased by 23.7% year over year, with the most significant growth occurring in exactly the 14 nations withdrawing from U.S. treasuries. The third destination is infrastructure bonds denominated in local currencies. Saudi Arabia's Public Investment Fund, which manages approximately $700 billion in sovereign assets, redirected $34 billion previously allocated to U.S. Treasuries into yuan-denominated infrastructure bonds under China's Belt and Road financial architecture during 2024. The UAE followed with $18 billion. Malaysia added $2 billion. These are not small positions. They are strategic reorientations by some of the most sophisticated sovereign wealth managers on Earth. The fourth destination, and this is the one that should alarm every analyst watching the dollar's long-term position, is bilateral trade settlement agreements that eliminate the dollar from the transaction entirely. India and Russia now settle approximately 60% of their bilateral trade in rupees and rubles. Brazil and China settled $94 billion in trade during 2024 using a direct real yuan exchange mechanism bypassing SWIFT entirely. Indonesia and China announced in March 2024 a framework for complete bilateral trade de-dollarization across 17 commodity categories. Think about what this means. Not for next quarter, not for the next election cycle, for the structural position of the United States in the global economy over the next 2 decades. Here is where the controlled urgency becomes necessary, because what is being ignored at the White House is not a matter of analytical disagreement. It is documented in the administration's own Treasury reports. The Trump economic team's public framing of this capital flight follows 3 consistent narratives. First, that dollar demand remains strong because Treasury auction bid-to-cover ratios remain above historical averages. Second, that America's current account deficit reflects global confidence in U.S. assets. Third, that any reduction in foreign Treasury holdings is offset by domestic institutional demand and Federal Reserve balance sheet management. Each of these framings is technically accurate in isolation. Each of them misses the structural shift entirely. Let's take the bid-to-cover ratio argument first. A Peterson Institute for International Economics Analysis from November 2024 makes the following observation, which has received almost no mainstream coverage. The composition of Treasury auction demand has shifted dramatically. In 2019, foreign central banks and sovereign wealth funds accounted for 43% of successful bids at 10-year Treasury auctions. By the fourth quarter of 2024, that figure had declined to 3%. The overall bid-to-cover ratio remains healthy because domestic institutions, pension funds, insurance companies, and money market funds have absorbed the slack. But domestic institutions hold treasuries for yield and portfolio allocation purposes. They will rebalance when yields decline or when equity returns improve. They are not strategic holders. They do not hold treasuries because they are signaling participation in a global financial architecture. The moment that yield calculus shifts, domestic demand will rotate, and there is no sovereign floor beneath it. The current account deficit argument is even more revealing of the analytical gap. The United States runs a current account deficit that averaged 8% of GDP across 2024. The administration presents this as evidence of global demand for dollar assets. The correct reading, documented in Federal Reserve Governor Christopher Waller's February 2025 speech on reserve currency dynamics, is that the current account deficit is increasingly financed not by sovereign purchases of Treasury securities, which is the stable, long-term form of dollar demand, but by short-term portfolio flows and corporate debt instruments held by private investors. This is a structurally weaker form of financing. It is more volatile, more sensitive to interest rate differentials, and more likely to reverse suddenly during periods of global risk aversion. The Federal Reserve balance sheet argument is perhaps the most concerning in terms of what it implies about policy capacity. Yes, the Fed can absorb Treasury supply through quantitative easing, but the Fed's balance sheet currently stands at $9 trillion following partial normalization from its 2022 peak. Every dollar of Treasury demand that the Fed must absorb to prevent yield spikes is a dollar that maintains inflation pressure, constrains the Fed's future policy optionality, and further complicates the already politically toxic relationship between monetary policy and fiscal reality. Here is the number that connects all of this into a single coherent picture. The United States government will need to refinance or issue approximately $2 trillion in Treasury securities during 2025 alone. That figure includes maturing short-term debt, new deficit financing, and interest payments on existing obligations. $9.2 trillion. In a single year, with 14 major allied nations actively reducing their Treasury positions, domestic institutional demand substituting for strategic sovereign demand, and a Federal Reserve with constrained balance sheet capacity. The margin for error in that arithmetic is not large. In 1956, Britain launched what its military planners believed would be a swift and decisive military campaign to reassert control over the Suez Canal, following its nationalization by Egyptian President Gamal Abdel Nasser. Britain had the military capability. It had the political will. It had the strategic rationale. What it did not have, what it discovered, it lacked at the precise moment it most needed it, was the financial independence to sustain the operation without American approval. The United States, under President Eisenhower, told London with quiet but absolute clarity, withdraw from Suez or we will not provide balance of payments support for the pound sterling. And without American support, the pound would collapse. And without a stable pound, Britain could not finance its global military commitments, its welfare state, or its post-war reconstruction obligations. Britain withdrew from Suez in 48 hours. The mechanism that forced that withdrawal was not military. It was financial. It was the realization, arriving in the offices of the British Treasury in real time, that the pound's global reserve role, the role that Britain had maintained since the 19th century, the role that financed its empire and underwritten its global power, was entirely contingent on American confidence. The moment that confidence was withdrawn, the entire architecture of British global power became unaffordable. Britain didn't lose its reserve currency status in a single dramatic crisis. It had been losing it since 1944, when Bretton Woods established the dollar as the world's primary reserve currency. But the Suez moment was when that structural erosion became operationally decisive. When it mattered, the question that every analyst tracking the $445 billion withdrawal must ask is whether 2024 and 2025 represent the dollar's Suez moment, not the moment it collapses, but the moment when its contingent nature becomes visible. When the nations that have held dollar reserves, not because they prefer dollars, but because they have had no credible alternative, begin to perceive that alternative as credible enough to act on. China does not need to destroy the dollar system. It does not need to propose a new Bretton Woods or launch a global yuan reserve program. It simply needs to make the alternative sufficiently functional that the marginal decision, the decision made by the Saudi finance minister, the Bank of Korea's governor, the Malaysian Central Bank Board, shifts from "there is no alternative" to "this is good enough." According to the Atlantic Council's Dollar Dominance Monitor, published in December 2024, the dollar's share of global foreign exchange reserves declined from 7% in 2001 to 4% in 2024. That is a 14 percentage point decline in reserve share over 23 years. It is not a crisis, it is a trend. And trends, by definition, continue until something changes the underlying forces driving them. The underlying forces driving this trend are not being addressed by the current administration. They are being accelerated. Let's be precise about who benefits from the $445 billion withdrawal, because the beneficiary is not random and it is not diffuse. Every dollar withdrawn from U.S. Treasury holdings and redirected into yuan-denominated instruments, bilateral swap arrangements, or direct trade settlement frameworks increases the operational viability of China's parallel financial architecture. Not because China designed this outcome, though it has certainly prepared for it, but because China is the only power that has spent the last decade building the institutional infrastructure necessary to absorb this redirected capital. The cross-border interbank payment system, known as CIPS, which is China's alternative to SWIFT for yuan-denominated transactions, processed 9 trillion yuan in transactions during 2024, a 3% increase over 2023. The number of financial institutions connected to CIPS reached 1,394 by the end of 2024, spanning 112 countries. These are not impressive numbers relative to SWIFT's 11,000-member institutions and $5 quadrillion in annual transaction volume. But they represent operational infrastructure. They represent a working alternative that, 18 months ago, did not exist at the scale required to serve the redirecting capital flows we have been tracking. When Saudi Arabia settles oil sales to China in yuan through CIPS rather than dollars through SWIFT, two things happen simultaneously. Saudi Arabia reduces its structural dependence on the dollar payment system, and China's yuan-denominated financial infrastructure gains transaction volume, institutional familiarity, and operational credibility that makes it easier for the next country to make the same decision. Network effects work in both directions. They built the dollar's dominance over 70 years. They can erode it over 20. The Peterson Institute for International Economics estimated in a March 2025 working paper that if the current trend of reserve diversification continues at its 2023 to 2024 pace for a full decade, the dollar's share of global reserves would decline to approximately 47% by 2034. At that level, the dollar retains reserve currency status in a technical sense. But the policy space that reserve currency status provides, the ability to run persistent deficits without triggering a currency crisis, to impose sanctions without triggering immediate capital flight, to finance military operations without congressional debt, ceiling negotiations, limiting operational capacity, narrows considerably. This is not a forecast of American collapse. It is a forecast of American constraint. And constraint for a nation that has operated without meaningful external financial constraint since 1945 will arrive as a profound and disorienting shock to both policymakers and the public. Here is where the abstraction becomes personal, because the consequences of what 14 nations are doing with their reserves do not remain in the sovereign wealth management offices of Riyadh and Seoul. They arrive in American mortgage markets, consumer credit costs, federal social program financing, and ultimately, the price of every imported good that American consumers purchase. The transmission mechanism is interest rates. If foreign demand for U.S. Treasuries declines, whether through the active withdrawal we have been tracking or through the passive failure to absorb new issuance, the federal government must offer higher yields to attract alternative buyers. Higher Treasury yields do not stay in the bond market. They permeate the entire interest rate structure of the American economy because virtually every consumer and corporate borrowing rate is benchmarked against the Treasury yield curve. A 1 percentage point increase in the 10-year Treasury yield from, for example, 2% to 5%. 2% increases the annual interest cost on a $400,000 30-year mortgage by approximately $2,400. It increases the annual carrying cost of the average American household's credit card debt by roughly $340. It increases the federal government's annual interest expense on its existing $5 trillion debt by approximately $345 billion, money that does not build infrastructure, fund education, support veterans, or maintain defense readiness. It simply pays bondholders. These numbers are not projections. The Congressional Budget Office's January 2025 budget outlook already projects federal interest payments reaching $1.05 trillion annually by 2027 under baseline assumptions that include continued foreign treasury demand at current reduced levels. If foreign demand declines further, and the 14-nation capital flight suggests it will, the interest expense trajectory becomes materially worse than the CBO baseline. The mortgage rate impact is already visible. The 30-year fixed mortgage rate averaged 7.1% during the first quarter of 2025 compared to 2.7% in 2021. That 4 percentage point increase has effectively priced approximately 32% of American households out of the single-family home purchase market, according to National Association of Realtors Affordability Index data. This is not entirely attributable to the reserve withdrawal. The Federal Reserve's inflation-fighting rate cycle contributed substantially, but the floor beneath which mortgage rates can fall is being raised by the structural reduction in foreign treasury demand. You are already living in the early stages of this adjustment. The question is whether the policy framework governing the dollar's future is designed to manage that adjustment toward a stable equilibrium or to accelerate it through continued weaponization of financial infrastructure and unpredictable tariff deployment. The answer to that question will determine whether this adjustment takes 20 years at a manageable pace or arrives concentrated in a 5-year window that the American financial system is not designed to absorb. Conclusion: the reality that cannot be ignored. 14 nations have withdrawn $445 billion from U.S. reserve assets in 22 months. They have redirected those funds into gold, yuan-denominated instruments, bilateral swap arrangements, and trade settlement frameworks that bypass the dollar entirely. They have done so not in hostility, but in calculation, the same calculation that professional financial managers make when they determine that concentration risk has exceeded acceptable limits.